Ladies and gentlemen, good morning. Welcome to the Frankfurt Finance Summit, the fourth summit of its kind. So we have a tradition. It's not a long one, but it's a healthy tradition. Welcome to the West End campus of the University of Frankfurt, the Goethe Universität. I hope you like it as much as I do. I just have a little plan. If I turn 100, I will go back to the university and to this one here and be on the campus for the rest of my life. I think we have a full program today, and I would like to thank in advance everybody who is contributing to the program. We have very prominent, excellent speakers. We have very good, prominent moderators. We have wonderful facilities. And we have, I think, a lot of subjects on our minds, which I think we will have to cover. As we all know, we find out where we are with our industry particularly. And we have the inkling that we are somewhat through, but not quite through. And I think it's very worthwhile discussing what will happen. And I think no better place at the moment than Frankfurt. We have all the regulators here. I would like to particularly welcome Madame Nouy, our newest addition, so to speak. And we are very honored that you will talk to us. I also would like to welcome Monsieur Barnier, and we are looking forward to you both kind of kicking off the conference. Other people I would like to welcome is Mr. Farkas, the Executive Director of the European Banking Authority, Andreas Stormbredt, who is going to arrive, a member of the Executive Board of Deutsche Bundesbank, and some of them will know, others not, that he has just switched responsibilities. He is now responsible for the area of bank supervision in the Bundesbank, after he was the Secretary of State, so to speak, for the Bundesbank for the last couple of years. Mr. Janacek, the member of the board of the Czech National Bank, Mr. Ingves, the member of the General Board of the European Systemic Risk Board, Luis Linde, the governor of the Banco de España, and many others. Particular welcome to Thomas Schäfer, who is the Minister of Finance of the state of Hesse. And in fact, without the state of Hessen, without the states in Germany, in our political structure, you will not have universities. So he, in a way, is one of the masterminds behind this campus. I would also like our sponsors. They are all on the board here. We hope that some of you enjoyed the dinner last night. The discussion, I think we should start right now. My colleague Hubertus Veeth will be the little star that is guiding our way through the conference, and we try to be on time. And of course, in between, you're invited to be outside. We have wonderful sunshine, which hopefully is a good omen, not only for the conference, but for the state of our industry. So with this, I would like to lead to our host here. Professor Klump is the Deputy Chairman of the Goethe Universität. Thank you very much that we are allowed to be in your quarters, so to speak, and that we will use them. Thank you.
Dear Dr. Raettig, Minister Schäfer, Commissioner Barnier, chère Madame Nouy, distinguished guests, ladies and gentlemen. Today it's with my great pleasure that I can welcome you here at the campus of Goethe University, the new campus of Goethe University, and in particular in this new administration building on this campus, a building which was inaugurated almost exactly 1 year ago. And as you can see, it represents yet another landmark in the exciting development that has been taking place on our Western campus over the past years. And I have to say thank you again, especially to the Minister of Finance of the state of Hesse, who in the end was responsible for financing all this. I was extremely happy to hear that Frankfurt Main Finance has decided to select Goethe University and this campus to host the Frankfurt Finance Summit for the 4th time. All the more so since this year, 2014, as many of you will be aware, marks this university 100th anniversary. In fact, the year 2014 is not only our centenary year, it happens also to be the 150th anniversary of the birth of the great German economist Franz Oppenheimer. And before this background, please allow me to recall that it was here at Goethe University in Frankfurt that the first German faculty of economics and social sciences was founded 100 years ago. Franz Oppenheimer, who was then appointed at one of the first chairs of economics and social sciences in Frankfurt. Franz Oppenheimer was an economic pioneer in the early and particularly liberal years of this university. His innovative insights advanced both teaching and research. But Oppenheimer's contribution was not limited to the academic sphere. His quest for an ideal economy and society gave rise to a new strand of economic policy with a particularly far-reaching impact. Ludwig Erhard, later the first Minister of Economics of the Federal Republic of Germany, Ludwig Erhard was the most famous of Oppenheimer's students, and he adopted Oppenheimer's principles as a starting point from which he developed his concept of social market economy, which became then a guideline for the development in the Federal Republic of Germany after the Second World War. Talking about achievements in academics here at Goethe University, especially in economics, I should also recall that Reinhard Selten, by now the only German winner of the Nobel Prize in economics, also was a student at Goethe University and started his research on behavioral and experimental economics here in the 1960s. Ladies and gentlemen, as you know, in keeping with this tradition, Goethe University continues its strong reputation for innovation in the field of economics. As I'm sure you are all aware, when it comes to finance, teaching and research, this university considers its House of Finance to be a shining beacon. In this respect, it is a particular pleasure for me to report on a new milestone in the House of Finance success story. Last year, under the State of Hessen Löwe program, a program to support academic excellence, a multi-million euro grant for the research center Sustainable Architecture for Finance in Europe, SAFE, was approved. To make this center SAFE operational, 11 new professorial positions were filled with renowned international academics. Internationally visible research will be at the core of the center's working agenda, but another of SAFE's goals is to set up a dynamic form of interaction with both policymakers and society, and to encourage a critical mass of young researchers and professionals to engage in its activities. I'm proud to report that SAFE is well on the way to fulfilling its mission of becoming one of the leading research centers on finance in Europe. Ladies and gentlemen, allow me please to finish with a very personal remark. My office as a vice president of Goethe University is coming to an end later this year. You may have heard or may have read this morning in the paper that I've been elected rector of the University of Luxembourg. And this is a new university, also a university with a very strong and very reputed School of Finance. Please rest assured that I will do my best to contribute to the dialogue between the two financial centers, Frankfurt and Luxembourg. And both Yves Mersch and Gaston Reinesch have already expressed their support. And I would also be extremely happy to maintain the close contacts I have developed with many of you over the past years. And for now, I would just like to close by wishing you, all the participants here, a fascinating day full of new insights and interesting conversations. Thank you very much.
Dear Lutz, Raettig, Commissioner Barnier, Madame Nouy, Vice President Klump, ladies and gentlemen. Thank you for the opportunity to address these words of welcome to you on behalf of the government of the state of Hesse. And also I would like to apologize myself that I have to leave you soon after my speech because the state parliament of Hesse is discussing the state budget today. And when the Minister of Finance is absent, it will be very expensive for the Minister of Finance. Therefore, I hope for your understanding. Frankfurt is changing with the European Central Bank. These small few words, I think, best describe the major changes and developments currently happening at the financial center of Frankfurt. Most obviously, it is changing in terms of architecture due to the construction of the new ECB premises in the city East End. But Frankfurt is also changing due to the ECB's new responsibilities within the framework of the banking union. By autumn this year at the latest, the largest and systemically important banks in the Eurozone will be supervised from Frankfurt. And with these new responsibilities, hundreds of banking supervisors from all different countries will come to Frankfurt and will enrich the city. And now I will use the opportunity to send a very warm welcome to all of them. First of all, for Madame Nouy, very warm welcome to here in Frankfurt. Ladies and gentlemen, the banking union is, however, more than just a centralization of banking supervision in Frankfurt. Looking back to the discussions of recent weeks and months in Brussels, the significance of the banking union projects becomes very clear. It is a central cornerstone aiming to limiting the state's liability for rescuing of bank. This will ensure that taxpayers would not again have to bear the costs of large-scale rescue packages. The success of the banking union is therefore a common concern to all of us in the Eurozone. As you will all know, the European legislators recently paved the way for the banking union. That said, it will now be essential to ensure that this banking union will be ready in every detail. As to the single supervisory mechanism, preparation are in full swing. The single resolution mechanism, however, includes a whole set of new instruments, structures, and procedures which require all those involved to prepare themselves. Particularly when it comes to a so-called bail instrument providing for creditor involvement is in the rescue of banks. I'm very happy that with the bail-in instrument, the European legislators have agreed on a set minimum participation of creditors. Not only does the minimum threshold of 8% of balance sheet total provide a reliable framework for financial markets, it also sent out the signals to citizens that creditor participation is not just something that exists only on the paper. The fact that the European legislators permit the member states to deviate from the minimum participation in exceptional circumstances, it is an issue which would certainly be carefully monitored on the way to proceed. It is especially true, as in the context of the banking union, the Single Resolution Fund will be established over the next few years. Specifically intended to the European legislators, this fund which is to be established by the banking sector, will be used first, without recourse to taxpayers' money. This outcome is to be highly welcomed. I am also very pleased that during the build-up phase to the fund, contributions by each member state are deposited into separate national compartments. Ladies and gentlemen, a continued improvement in the budgetary situation of the euro area member states is one of the major challenges in our time. Looking for ways out of the sovereign debt crisis, the six-pack and the fiscal compact in particular have been important decisions at the international level. In my view, these efforts have been setting the right framework for the sound budgetary policies in the European Union. We all must always remember the main cause of the debt crisis was the country's deficit policy in the years leading up to the outbreak of the financial crisis. Many states have been living for beyond their means, amazing huge debts. In order to lean from the debt crisis and build public finances on a solid foundation for the future, it is essential to comply point by point with a stricter regulation framework. Germany should serve as an example. It is also especially important that in many cases banks are closely linked to the national banks' budgets. Especially in the crisis countries, they hold a large share of the government bonds issued by their home countries. That's why I have been following with great interest many policymakers who are looking to review regulatory incentives which make it particularly attractive for banks to hold sovereign bonds. On such incentives is the 0% risk weight of sovereign bonds in banking supervision. Not only, ladies and gentlemen, has Frankfurt been the second largest financial center in the EU for a long time, but it's also ranked among the world's top 10 financial centers in the area of supervision and regulation, which is hardly surprising. I'm sure that this year the Frankfurt Finance Summit will provide delegates once again with an excellent platform to discuss and exchange ideas to shape the future of finance. For this year's Frankfurt Finance Summit, the organizers have chosen what I think is a very good motto, the State of the Union. After years of putting up massive rescue packages and initiating regulatory measures in a response to the crisis, is it now time to take stock of the situation and to focus on the challenge ahead? Such taking stock, in my opinion, includes a review of existing regularity measures, not just in terms of sheer numbers of measures, but also in terms of contradictory incentives and opposite effects. We should not forget to carefully evaluate these, despite all the discussions about the challenges to come, such as the banking union. I would like to end by thanking you all for participation. The fact that you have come to attend this conference should confirm that the organizers' concept is working well. I would also like to thank the organizers. Ladies and gentlemen, I hope you will enjoy the most inspiring, informative summit as well in the fruitful discussions for the future of the financial sector. Thank you for coming and thank you for attention.
Thank you, Minister Schäfer. Thank you, Professor Klump, for that warm welcome. Let me share with you that as of that moment, about 2,000 people are watching live on internet what is raised in Frankfurt. And what is raised in Frankfurt as a State of the Union, I'll be calling on Commissioner Michel Barnier, who is the architect of that very union. Who else could more enlighten us on the subject than him? Very warm welcome.
Thank you very much. Good morning to all of you, and vielen Dank, Dr. Schäfer, and all the best for the budget. Your budget, for the taxpayers too. And also many thanks to Dr. Lutz Raettig, Professor Rainer Klump. Congratulations for your very important and new function in Luxembourg, and also Thanks to Hubertus Fate of Frankfurt Main Finance for inviting me to speak at this conference, to give me the opportunity to come back in this room and this university. I think for a long time that at any stage of our life we need to come back to university and we have something to learn. Always something to learn. And as is even proves, this city has grown in a major financial center for Germany and its economy, but also for the single market and the rest of the world. Frankfurt attracts people and business, not only bankers. This is my second visit to Frankfurt in less than 1 month. And Danièle, Nouy, I can say that many people, none less than 8,000 people have applied to work with you. You don't need 8,000 people, but I hope so. But it is a proof of the importance of this place and also of your work. Ladies and gentlemen, citizens in Europe are called to vote later this week in the elections to the European Parliament. And I hope they will go to vote, given the importance, the role of the member of the European Parliament. And Wolf, where are you? Somewhere. Can confirm this importance and the role of the Parliament. Moreover, these elections take place as a turning point for Europe. We have lived through 6 years of financial crisis and 3 years of sovereign debt crisis. The economic outlook is improving, but the social consequences of the crisis are still felt across Europe. Compared to 2007, unemployment in absolute numbers has increased by 9 million individuals. Many are 20 years old or younger. SMEs, in particular in Southern Europe, have difficulties obtaining the credit they need for their business, and many companies have failed. So, this week's elections are not, first of all, about Brussels or institutional powers. It's about the EU added value. It's about people, growth, and jobs. And many citizens are asking, why does Europe matter? How does Europe help us? One important part of the answer is the fundamental reform of the financial sector, which Europe has carried out over the past year. Ladies and gentlemen, you know that Europe has implemented the G20 agenda so that every market, every player, and every activity is regulated and effectively supervised. And if you just take 2 or 3 minutes to look at my favorite table, the progress is clear now because the main files are in green. That means that they have been voted by the Parliament and the European Council and the Council of Ministers and more or less now operational and implemented, even if some main proposals for the regulation of the shadow banking or the structural reforms of the biggest bank, the 29 biggest bank, and also the regulations of benchmarks are still on the way and the pipeline of the legislative process. But we have created, in the framework of this agenda, new supervisory authorities to supervise banks, markets, and insurance companies in a consistent way. EIOPA, the insurance authority, is located here in Frankfurt. Adam Farkas from the European Banking Authority in London will speak at this conference later today. And let me be clear, these fundamental reforms would not have been possible without joint action by the EU. Europe's financial markets are too interlinked to be dealt with nationally. Many European financial institutions are major players, not only in the single market, but also on the global arena. Deutsche Bank, Deutsche Börse, Allianz, just to mention a few German examples. So we need common rules and regulatory convergence. We need the EU. The past years have also brought to light how close member states and the banking sectors are tied together by the EU, the euro. We have finally realized that the joint currency is not sustainable without joint bank supervision and resolution, and also without integrated capital markets. And on this point, we are not at the end of the road. But our response has been decisive and clear. Together, we have turned the idea of a banking union into reality in less than 2 years. Ladies and gentlemen, the banking union is probably our biggest project since the euro itself. The single supervisory mechanism and the single resolution mechanism will ensure a truly European system. At the same time, the system is, in my view, proportionate. It was never the intention, and never my intention, that the SSM should carry out the day-to-day supervision of small or local institutions. But as we learned during the crisis, small banks can create big problems sometimes. If this happens, the SSM will intervene. This is essential for financial stability. Now, the practical preparation for SSM are moving at light speed. I'm sure that Danièle Nouy will go into this in more details. The second pillar of the banking union, the SRM, will be fully operational in 2016. It will ensure that bank failures are dealt with jointly and quickly over a weekend if necessary. The SRM will apply the Bank Recovery and Resolution Directive, the BRD, the new single market framework, to treat failing banks. The rules are very clear. If things go wrong, the bank's shareholders and creditors have to pay first. Only if shareholders and creditors take losses amounting to 8% of a bank's total liabilities, the Single Resolution Fund, pre-financed by the banking sector, can intervene as a last resort. This 8% rule is stricter than the system already in place, for instance, here in Germany. In fact, the new EU rules are one of the world's toughest in terms of imposing losses on banks, shareholders, and creditors. They guarantee that taxpayers are no longer in the front line to save failing banks. So, this is not business as usual. This is a new world of dealing with failing banks. I know, ladies and gentlemen, that some say that the fund is too small. There should be no misunderstanding. Of course, the SRM needs access to funding, backed by temporary bridge financing. But let me be clear, if the new BRD rules would have been in place during the crisis, or at the beginning of the crisis, the fund would have been used only once during the whole crisis to recapitalize a bank. And I want to make one last point in this context. We are not setting up a bailout fund. The SRM is not a matter of taxpayers from one country being called on to save banks in other countries. At the heart of the SRM, a strong and efficient single resolution board will be the guarantor that the new rules are applied. National authorities remain responsible for resolution decisions for less significant domestic banks subject to European oversight. We have also been careful to take into account the specificities of business models such as saving banks or cooperative. And I will continue to take into account these specificities and the diversity also of the banking sector in Europe over the coming months to determine in detail which bank pays what into the Single Resolution Fund based on size and risk profile. I am aware that it is a matter of concern for the German Bundestag, represented today on the panel by Gerhard Schick, but also for other national parliaments, not only in Germany. We will examine the intergovernmental agreement that supports the SRM in the coming months. I want to assure you that we are coordinating this important work very closely with stakeholders, member states, and European Parliament. Ladies and gentlemen, the mentioned reforms have been essential to build or to rebuild confidence and stability in the financial markets, and to ensure that funding flows to the real economy. Looking at this from the European perspective, we have to address the uneven recovery in Europe. This year, Poland's economy is set to grow by 3.2%, while the figure for Italy is 0.6%, or in France, just 1%. And 5.5 million young people, almost 1 in every 4 young adults in Europe, are unemployed. Germany has a lot to contribute in this context. Your vocational training system has a proven track record. The German Mittelstand is world-leading in many areas. German best practices can be a source of inspiration for other EU countries. And benefits will be mutual. A strong European Union is good for Germany, and recovered demand in other EU countries means opportunities for German business. Renewed confidence in the financial markets mean increased domestic demand and consumption. Ladies and gentlemen, some of the challenges we will face in the coming years or in the coming months are national and are best dealt with the national level. But many issues affect us all: the security of the EU borders, the demographic challenge, the energy dependence, immigration policies, climate change. We need to face these issues together, rather than every country on its own. We need to renew the EU industrial base, reduce our energy dependence, use the full potential of the single market, invest in education and key technologies. This must be, in any case, this must be the key priority for the new Commission at the end of this year and for the coming years, and also supported by the Parliament, the new Parliament, and the Council of Ministers. The financial markets here in Frankfurt and elsewhere need to be part of the solution. This is why we launched last year work on long-term financing and investment, followed by a communication in March this year. And contrasting to what was claimed in the press, and I want just to make this point, last week, this communication did not propose a new EU saving products to the detriment of national existing product. What we are thinking about is to look into how private savings could be used in a more efficient way. Nothing had been decided yet, but we need to find this way to use in a more efficient way the private savings to promote innovation and SMEs. Many of the institutions represented here today have been very active in the debate in long-term financing, and I want to thank you. I would encourage you to continue. This is a work stream that will remain crucially important for the foreseeable future. So now I want to apologize if I have to leave right now, not to deal with a budget, but just to take my plane, to get my plane and to prepare the weekly meeting with the Commission tomorrow. But I want to thank you for your invitation. Thank you for your attention. Thank you. Vielen Dank.
Thank you, Commissioner Barnier. You remember he showed you the roadmap with a lot of greens on it. You will be handed it out once you leave it here. We'll have them available. So thank you very much. And the house you build, if you permit me saying that the House of the Union you build will be inhabited by, amongst others, and chaired amongst others by Danièle Nouy. With a few of the 8,000 applicants, I'm not sure whether she's still accepting anymore, I doubt. But we are very, very happy to have you here, and we're wondering on what kind of a life, what kind of ideas you will bring in that new house of the Banking Union Europe. The floor is yours. Thank you very much.
Good morning to all of you. Thank you for inviting me here at this summit. It's a pleasure to be able to address such a great audience. The topic of the next panel, the state of the European Banking Union, is in my view very well chosen at this point in time. We stand just before the historical moment where the European Union will, for the first time, have a single supervisor for the banks of the euro area and for any other member state that will want to join us. It is thus only fair that we take stock on what we have achieved, on where we stand. Today, I would like to focus on the supervisory aspects of the banking union and discuss two things. The first one is to briefly remind you of Europe's significant achievement over the past 5 years, as I believe that it will put things into perspective in how far we have come in a short period of time. As chair of the supervisory board of the SSM, my goal for the SSM is to be a robust and effective supervisor, contributing to the safety and soundness of banks in the SSM area, to support financial integration, financial stability, and economic growth. And in order to achieve this goal, the SSM will need to overcome some challenges. In a second step, I will therefore have a forward-looking view and discuss the challenges ahead of us. So turning to the first part, what have we achieved so far? Looking back since the start of the crisis in 2008, I can say that we have come a very long way forward in a relatively short period of time. To see this, remember that at the peak of the crisis, which was barely 2 years ago, there were fears about a breakup of the euro area, and markets were pricing in this risk. Today, however, the euro area is on a much sounder footing than before, and a complete overhaul of the institutional setup was achieved. Let me name a few elements. Since 2008, we improved the effectiveness of European crisis management with the European Financial Stability Facility, the European Stability Mechanism. We have established the European Supervisory Authorities, including EBA, and Adam Farkas, the DG of EBA, will address you and us. The European Systemic Risk Board as well was established. And last but not least, we are, of course, working very hard on the implementation of the banking union. In addition to the complete overhaul of the institutional setup, the regulatory landscape has also been revised substantially. The Capital Requirement Directive and Regulation introduced new requirements for the level and quality of capital, new rules on liquidity, an instrument for macroprudential supervision. In December last year, a political agreement was reached on the Bank Recovery and Resolution Directive and recast Deposit Guarantee Schemes Directive. Both these directives will ensure an harmonized framework across the European Union for resolution and deposit guarantee schemes, and they were a prerequisite for the single regulatory mechanism on which an agreement was also reached recently. But despite the fact that we have come a long way forward in a short period of time, we are, however, not yet there. Challenges remain. For the sake of time, I will address only quote-unquote 4 of these challenges, 2 for the short term and 2 for the long term. Our first short-term challenge is to help rebuild confidence in the balance sheet of SSM area banks. And I don't need to tell this audience, I guess, that we are performing a comprehensive assessment to this end. Most of you will be familiar with the components of the comprehensive assessment, the asset quality review and the stress test. So I will not dwell on its details, and I will only stress the magnitude of the exercise. We are talking about 128 banking groups, 128 banking groups, 760 banking book portfolios, on 135,000 credit files reviewed, covering 3.7 trillion euro of risk-weighted assets, and representing 58% of the total credit risk-weighted assets of the banks in the scope of the review. In total, as was stressed by Commissaire Barnier, more than 6,000 supervisors, external auditors, consultants, and specialist appraisers are working on the asset quality review. And this asset quality review is complemented, as you know, by a stress test more stringent than in the previous exercise, performed by the same 128 banks to test their resilience to adverse circumstances. My second short-term challenge is to get the supervisory board and the SSM preparatory work done before assuming supervisory responsibilities on 4 November. The latest milestone we achieved in this respect is the finalization and publication of the SSM framework regulation on 25 April. The purpose of the framework regulation is to lay down the rules and procedures governing the cooperation between the ECB and the national supervisors, because the national supervisors are still very, very important, including for the significant banks, not only for the less significant. To define the rights and obligations of the supervised entities and third parties, and to address in the same document, to make it more useful, more operational, a few other issues which are necessary for the good functioning of the SSM. We also have to finalize our supervisory manual, which is reflected, finalize the supervisory model, and this is reflected in the supervisory manual of the SSM. Through this supervisory manual, we are ensuring that the same supervisory standards will be applied across the banking union, and through harmonization with the European Banking Authority across the European Union as a whole, not only the banking union. And last but not least, we need to recruit about 800 supervisors, and as Michel Barnier said, indeed, we received 8,000 applicants for those positions, and it's not finished, in fact, because we are with the middle management levels right now, at least for the horizontal function, DG4. We are also progressing well on this front, the recruitment of the supervisors. We need excellent European-minded supervisors. And as was said, our call for applications have been very successful. To a certain extent, too successful, because we have to screen a lot of CVs, but it's good to know that there are so many enthusiastic people willing to help building this historical achievement, which is the banking union and the SSM. Most of the recruiting campaign should be completed before the summer break, and I am confident that the critical mass of staff will be in Frankfurt in the ECB before 4 November 2014, when we take over the responsibility for supervision. Turning now to the 2 long-term challenges that I wish to address. First, we need to ensure that supervision is performed with a true European view. Supervisors in the ECB will come from a diversity of backgrounds, but the supervisory culture for the SSM should be and will be a European culture with no national bias. It is with this objective in mind that the SSM regulations provides for independence provision for the members of the Supervisory Board that should act in the interest of the Union as a whole. Similarly, with this objective in mind, the ECB has introduced the concept of joint supervisory teams. These joint supervisory teams are responsible for the operational supervision of the significant banks, and they will consist of supervisors from the center and from the national supervisory authorities. And even for the significant banks, 90% of the staff of the joint supervisory team will be the staff of the national supervisory authorities, the BaFin and the Bundesbank for the German banks. So you see, it's a close cooperation with our colleagues in the National Supervisory Authority. And I am visiting, before the end of this year, all the 18 countries and supervisory authorities to tell to my colleagues in the supervisory authorities that we need them. We are not able to do anything without their support. This is what will allow us to incorporate the national expertise while at the same time ensuring a European view on the supervision of banks. And I am very ambitious in this respect. I want to make the SSM function as a European institution taking European decisions. And I believe that the accountability towards the European Parliament is very helpful in this respect. Turning to the second long-term challenge ahead, before I conclude, we need to ensure that there is a convergence of supervisory practices. Ideally, we would have fully harmonized EU regulation. But there are still many, in my view, probably too many national options in the CRD4. As a result, it's not very easy for EBA to deliver the single rule book as requested by the regulation, and it's not so easy for us to deliver our manual, which is embedded within the single rule book. Regarding this manual, it cannot and it must not be only words in a document. It must be implemented in all SSM countries to foster the necessary convergence of supervisory practices. And we will make sure that this is taking place. Of course, this manual will be a living document subject to a continuous review process against internal evaluations, internationally accepted benchmark, and international regulatory developments. My ambition is to make the SSM a benchmark for supervisors worldwide by integrating the best supervisory practices from the SSM countries. And of course, this has a very strong team building dimension as well, and integrating as well other best supervisory practices beyond the SSM when it makes sense. To conclude, I would like to take you back to 25 February 2009. On that day, the De Larosière report was published, advocating the creation of a European system of financial supervision on a common framework for bank resolution. If at that time, Monsieur de Larosière would have suggested to have a single European supervisor and a single European resolution authority, instead of the decentralized network he proposed in the report, I think that the diplomatic reaction would have been, that is not realistic. 5 years after the De Larosière report, and less than 2 years after Europe committed to build a genuine banking union, this is where we stand. Europe has delivered on this banking union promise, and for those who criticize Europe for being too slow sometimes in taking decisions, I think that this is a testimony to what Europe can achieve when it sets its minds to it. I'm therefore confident that we will achieve our remaining challenge and we will make sure that the SSM is a success. Thank you for your attention.